All right, let's jump right into this one. Today, we're diving into a genuinely fascinating earnings report from Outdoor Holding Company, mapping out their recent journey to profitability. Whether you're an investor or just an avid user of their gunbroker.com marketplace, this is an incredible look at how to pull off a massive corporate turnaround. For those who might not know the name off the top of their head, they're the parent operator of gunbroker.com, the massive online marketplace for firearms and outdoor gear. We're going to unpack exactly how a company transitions from taking really heavy losses to generating positive cash flow, all using the very data they just reported.
Here is our roadmap for today's explainer. We'll start with the turnaround itself, look at the fiscal 2026 numbers, dive into how they cut costs while boosting tech, and finally, wrap up with liquidity and their future outlook. Let's get to it.
Part 1. The turnaround. And wow, they're calling it a year of remarkable improvement. So, to really get where this company is headed, we've got to look at the massive strategic shift they just pulled off. They pivoted hard toward a streamlined e-commerce approach, shedding heavy asset burdens, like divesting their entire ammunition manufacturing segment. And look at the result, a staggering $22.9 million drop in operating expenses in just one quarter. When you're analyzing a corporate turnaround, that right there is the holy grail. They didn't just trim around the edges, they significantly slashed headcount, legal spend, and facilities costs.
Steve Irvin, the chairman and CEO, pretty much hit the nail on the head here. He noted that their fourth quarter capped a year of remarkable improvement, saying they sustained momentum, grew profitability, and generated positive cash flow. Basically, it's a brilliant pivot, right? Stop the financial bleeding on the back end and pour those resources directly into the front-end, customer-facing engine.
Moving right along to Part 2, by the numbers. Let's see how they went from heavy losses to profitability.
You know, strategy sounds great on paper, but it actually has to show up in the ledger. Looking at the raw financial data here, net revenues climbed to $51.1 million and gross profit rose to $44.6 million. But to really grasp the sheer magnitude of this shift, we need to pull a few specific metrics out of this massive sheet. Just look at this stark juxtaposition. Back in the fourth quarter of fiscal 2025, they posted a net loss attributable to common shareholders of negative $78.3 million. Ouch. But fast forward exactly 1 year to Q4 2026, that loss shrank down to just negative $1.5 million. Think about that. Erasing nearly $77 million in losses in a single 12-month period is a colossal recovery for the bottom line.
Now, before we hit the next metric, let's quickly define Adjusted EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization, adjusted for non-recurring events. Why does this matter to us? Well, in a turnaround year that is full of legal payouts and corporate restructuring, Adjusted EBITDA completely cuts through the noise. It is the truest lens we have to see if the actual underlying business is making money.
And when we look through that operational lens, the growth is just undeniable. They went from $2.9 million in Q4 of 2025 up to $7.7 million in Q4 of 2026. They literally more than doubled their core profitability in just one quarter. That is huge.
But here's the crucial part. This wasn't just some uniquely lucky quarter. The entire year saw consistent, sequential growth, ultimately hitting $22.3 million for full-year Adjusted EBITDA. Management actually blew past their own $25 million annualized target way ahead of schedule. Talk about executing on promises and delivering value to shareholders, right?
Okay, let's switch gears slightly to another key term for understanding their marketplace health: take rate. Since gunbroker.com is an online marketplace connecting third-party buyers and sellers, the take rate measures how much revenue the company actually captures from the total value of goods sold on the platform. Basically, if you sell $1,000 of gear, what percentage does the platform keep? Well, it turns out their take rate remained incredibly stable at a little over 6%, and that is a fantastic sign, especially because total gross merchandise value, the total value of all those transactions, jumped by 10.1% to roughly $229 million for the quarter. What does this actually mean for us? It means engagement is sky high. Buyers and sellers are moving way more gear, and the platform is keeping its slice of a much larger pie without needing to discount its services.
All right, Part 3, cutting costs and boosting tech. Let's see how they built this asset-light e-commerce engine.
These operational highlights show a really brilliant dual strategy. On one hand, they aggressively tackled the past, settling a $4.4 million legacy legal matter specifically to avoid bleeding out over trial costs.
But on the other hand, they didn't just sit on the savings. No, they invested heavily in the future. They brought on a director of AI strategy, deployed a brand new AI-powered tool to help sellers generate standardized product listings, and completed their master FFL integration to completely streamline the complex transfer of federally regulated firearms. They basically cleaned house and then bought all new, high-tech furniture. This specific detail is one of my absolute favorites because it proves those upgrades are actually working. You might be wondering, hey, is there growth just because the whole industry is having a good year? Well, the data says no. While adjusted national background checks, or NICS checks, went up by just 1.6%, Outdoor Holdings saw their firearm unit sales surge by over 8.7% year over year. They aren't just coasting on an industry wave, they are actively capturing incremental market share.
Which brings us to our final section, Part 4, Liquidity and Future Outlook. How are they positioning for 2027 and beyond?
Just look at the sheer strength of this balance sheet. They ended the fiscal year sitting on $68.1 million in cash and cash equivalents. They essentially more than doubled their war chest from the $30.2 million they had at the end of fiscal 2025. And keep in mind, that is after paying out a $4.4 million legal settlement and spending $1 million buying back their own stock. Their liquidity right now is off the charts.
So armed with all that cash, what's the game plan for 2027? It's all about these clear sequential steps. Step 1, expand premium seller offerings. Step 2, enhance pricing and promotional tools. And Step 3, implement universal payments. Every single move here is designed to reduce transaction friction, dramatically improve the user experience, and completely lock users into their ecosystem. They want to be the undisputed hub of the market.
So, we are left with the ultimate question. Can Outdoor Holding capture incremental market share and deliver durable profitability in 2027? With a rapidly expanding AI strategy, a clean legal slate, and a $68 million war chest, this newly honed asset-light model looks incredibly formidable to competitors. Yes, the financial turnaround we unpacked today is objectively remarkable, but execution on future tech initiatives is everything. Now that they've rebuilt the engine, just how fast can this marketplace actually go? Thanks for joining me on this deep dive into the data, and I'll catch you on the next explainer.